We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Jeff Clark, founder of thegoldadvisor.com and also the author of Paydirt. Jeff, thanks for joining me today.
Tom, it's great to be back with you. We haven't talked in a while, so this should be a good update.
Absolutely. And, it's always good to get you back on. It has been a while since we have spoken. And I thought today would be a good time to kind of reconnect and talk a little bit about really the state of the mining industry right now. What are you really paying attention to, and what is starting to grab your attention?
Well, first of all, it's obvious to me that we're in a bull market, that gold is in a bull market. There's a lot of evidence that we can go into that if you want. But the biggest thing that sticks out is you have a runaway gold price almost over 3,000 now. And yet the mining stocks as a group haven't really moved all that much. A lot of them remain stuck. Now, there's been some that have had big jumps. We've had some doubles and triples already, but many are just sitting there like stranded in the ocean, So that's the biggest thing that sticks out to me. And what that tells me is the opportunity for us as mining stock investors is still ahead yet. There's not really a period in history where gold has run and the mining stocks never did. It's kind of like how many of us, and I'm sure many in your audience know, that's gold leads and silver lags, right? But silver eventually catches up and passes gold in terms of a percentage gain, right? Well, it's the same with mining stocks. They tend to lag, and then they tend to catch up and pass gold in terms of a percentage return before it's all over. We even saw that in the last bull market. Believe it or not, gold outperformed gold stocks, mining stocks, from 2001 to 2008. Then we had the crash, right? But from that bottom in 2008 to the top in 2011, gold stocks outperformed gold. So I think we have a similar thing that's probably ahead for us. There's no certainties in life, so you have to make sure that you own gold. But I'm pretty excited about what the future can offer for those of us who like to invest in mining stocks.
Mm-hmm. Well, there's definitely seems to be a real hierarchy in this industry, right? We go from gold to silver, gold seniors to explorers and juniors. So why don't we start with the biggie? Are we still, relatively new into this bull market, and how would we know that?
We are new. Some of the seniors have moved, but many have not. What really sticks out to me there that I should probably bring up is the cash flow and earnings, how they have jumped so dramatically from the producers. If you look at a table of earnings and free cash flow of the 6 largest producers in North America, Newmont, Barrick, Agnico, Kinross, AngloGold, and IAMGOLD, the earnings from year over year, Q4 of 2024 from Q4 2023, the earnings of every single 6 of those jumped triple-digit percentages, over 100% for all of them across the board. Some were over 200%. One was over 300%. Now, there was some M&A among those producers, but the gold price was the biggest change in terms of their bottom line year over year. So when you see that, you know that the producers are printing cash, basically. And the same thing with free cash flow. Free cash flow is actually a little more honest barometer of corporate health, many analysts believe, including myself, than earnings, because you can play around with earnings, right? But free cash flow also jumped with all 6 of these producers from double digits to triple digits, again, primarily due to the gold price. So they're printing cash right now. And that has some big implications we can talk about if you want, but that's the biggest thing that sticks out to me. And so once there is a sector rotation, I think that's a key, Tom, to when demand is going to come into our sector, moving from the S&P into the gold sector, moving from the NASDAQ, moving from Bitcoin or crypto, I should say, moving from AI stocks. When those things go weak, like they have been, we're going to start to see demand increase in our sector, and it'll start with the senior producers. It'll go down to the smaller producers, then developers, then juniors. I think everybody knows that. So I think that process has started, and it's just a matter of making sure you're positioned to benefit from it when it actually does occur.
Absolutely, and I'd like to get into that topic, but Jeff, you mentioned this idea of the sector rotation. What do you think is the catalyst for that? And do we basically see the gold price just continuing to accelerate from here, or do you see normal pullbacks as being part of this cycle right now?
Oh, there'll always be normal pullbacks. It'll always be a 2 steps forward, 1 step back. Even in the mania in 1979, there were 6 pullbacks of 6% or more in a mania. So that tells us that as a gold investor, and especially as a mining stock investor, you have to expect pullbacks. You absolutely have to expect them. So just get used to it. On big runs, that tells you can take some profits. Maybe on big pullbacks, that's when you buy other things that maybe you missed or something like that. So that should be expected. And then what was the first part of your question? I'm sorry.
This sector rotation. What do you think
sector
might
rotation.
Be the catalyst for that?
Yeah. Yeah, so I think it's pretty simple. It's when the broader markets where a lot of mainstream and Wall Street are invested, when those markets go soft. No, they don't have to outright crash, but it could be a crash. It could be them just stagnating and going weak. It could be them going into a bear market. Fund managers and big money, they're looking for green on the screen, right? They want to know where to invest next if the sector they're in does go into a bear market. Well, hello, it's hard not to see lots of green on the screen when you begin to look at the gold producing companies. And so when those markets go weak, I think we do see a sector rotation over into our tiny little industry. And I think that's when it could get really fun.
Mm-hmm. Just sticking with obviously the kind of big papa again a little bit, why should we maybe be concerned or want to be buying gold up to July 4th?
Oh, so I've done some research on that, and I have a chart of that, and it basically averaged the gold price, the daily gold price movement from 1975 through last year. And when you look at that chart, it's really quite amazing, because what you see is that on average, gold rises January and February. It has a correction in March, and then it's kind of flat until early July. It kind of bumps up and down. So there's little upswings, there's little downswings, but it doesn't do anything dramatic. Again, we're talking, averages. But for some reason, the gold price bottoms on the 4th of July, the July 4th holiday in the US. And then it begins to rise in earnest. Now, it has that 2 steps forward, 1 step back routine. But Tom, it's like a straight shot from the 4th of July holiday or the day after up until like the first or second week of October. It tends to go flat again, and then it rises again at the end of December. But it's the biggest time of year in terms of seeing gold gain. And again, this is averages. So a lot of the big runs and the big crashes have been smoothed out, and averages, don't always play out. But that is what history shows. And it's pretty dramatic, because I've averaged ever since the time gold became legal to own again in the US. So from there till last year, that's what the averages say, is you probably want to be long in gold before July 4th, because it's more likely to rise from then till early October than not.
Mhm. Jeff, as we think about, another kind of catalyst here for the, let's say, more mainstream money coming into the gold sector, is there a possibility, that we get a steeper, more dramatic correction than we already have been, kind of this, 1 to 2% slide per day in the broader equities? Does that kind of end up affecting gold? And are you being careful right now buying equities because of that possibility?
That's a great question, because there's always going to be pullbacks. But let's look at the reasons why gold is rising now. It's because of, and I'm not making a political statement, but some of the things Trump is doing is forcing or pushing some investors into gold. The fear of higher inflation, all the tariff stuff, the geopolitical concerns, which, still haven't been resolved, political issues. Debts, deficits, that hasn't been addressed at all. We're probably going to see money printing again. I mean, there's a lot of vulnerabilities in the system right now, and all of that has conspired to be pushing the demand for gold higher, which pushes the price higher. So when there's wars and fears of inflation, people buy gold. They don't necessarily buy gold stocks. I think that's another reason why mining stocks have lagged. But with the caveat that there's going to be a correction at some point. There could be even a big correction of 10%. That wouldn't necessarily stop or kill the bull market, because we have too many other factors that are at play, big picture stuff that's at play. We haven't even talked about the dollar. We haven't talked about interest rates. I mean, there's so many factors that can impact gold, most of which would be positive for gold if they play out the way we think they're going to play out. So I think one should be prepared for a pullback. And the strategy there, for me at least, is very simple. You have a lot of cash. You have a lot of cash so that you can pull the trigger on a pullback. That's what you want to be able to do. But having that buffer, it's a psychological thing too. It gives you a little bit of a shield or some protection against correction. But Tom, I think this goes on for several years, the gold bull market, and mining stocks as a group haven't really started yet. So in my opinion, we have all that to look forward to as long as you're prepared for pullbacks and corrections.
Mm-hmm. Jeff, when we think about, holding a lot of cash, do you ever try to consider holding, short-term treasuries or anything like that to try and make a little bit of interest as you're holding that cash?
That's another great question. And yes, I do. So basically, I'm at both ends of the barbell. On the very conservative side, I'm holding gold, physical gold, cash, and I'm invested in some CDs as well. So that's the conservative side, and I have some of my cash in a CD that is earning interest. The catch there, of course, you have to be aware of is that a CD locks you in, and if you end that early, then you don't get that interest, or could even be penalized. And then I'm at the other end of the extreme of the barbell with junior mining stocks. So I'm at both ends, but I think it's a great idea I think you need, some gold and you need some cash, and then a portion of your cash being over in treasuries or CDs or whatever the case may be to earn some interest on you, especially if inflation goes back up again.
Mm-hmm. So Jeff, let's go back to talking, about this point that you made about the big producers just basically printing money right now. What are they doing with that free cash flow? Are they issuing bigger dividends? Are they buying shares back? Are they reinvesting in their own projects? What are most of the big producers doing?
Well, they're all doing their own thing, so they're doing some of all of that, right? The big thing for me, the big implication for me is, since I'm not really investing in producers all that much, I'm down more the junior market, the developers. The implication there for us as junior mining stock investors is, the miners are printing cash right now, and their debt has been going down steadily for years. And the net debt over EBITDA, if you look at that ratio, This year is projected by one analytical firm to be zero. They're going to have no debt on the books compared to EBITDA. And it's not been that way for a long, long time, right? So a lot of us have wondered in the junior sector, why in the world are these producers not buying these juniors when they're so cheap? I mean, they could buy 3 or 4 of them for what they could buy one for just before COVID, right? Why aren't they doing that? Well, now they have a lot more cash than they used to, and their debt is way down. So we are ripe for an environment where M&A is likely to really pick up pace because the producers now have cash, have cleaned up the debt on their books, and I think M&A is something that's on its way sooner or later in the junior market.
Mm-hmm. So again, it just seems to be this step-by-step process that you could really look at and kind of understand how this is going to play out, right? You want to clean up your debt first, then you can go look at M&A targets. So what are the types of, or are you looking at any specific companies, or let's say types of companies that will be M&A targets, or do you want to be investing in other targets that are closer to production on their own?
Well, yes, all the above. So early stage pre-discovery plays, the biggest bang for your buck, but the most risky. And then those that have made a discovery and are proving up a deposit and could be a very ripe target for a producer who's looking for, especially if it needs to be a big and rich asset, right? Just like my grandma's chocolate chip cookies, it's got to be big and rich, right? And then the developers, I don't invest too much in the developers. I'm waiting for that when they get to that pre-production sweet spot, where from the construction decision up to first pour, that's a very strong period where stocks tend to see a re-rating. Research from Lobo Tigre, my mentor from back in the day, his research shows this very clearly. And so I like to invest in that strategy. We've got several stocks right now that are in that sweet spot. So there's the gamut, and all have different risk quotients and that sort of thing. But as far as targets for M&A, when you're considering a target, it's also going to be a company that is a strong company to begin with as an investment, regardless of whether it's an M&A target, right? So you want strong people, pro-mining jurisdiction, the big project, or a project that can become big. You're looking for the same things. And sometimes we get surprised. A company gets bought out that we didn't think was going to get bought out, and one that we think doesn't. So you have to be a little flexible. Don't count on M&A. Still just look for the very strongest companies in the industry.
Mm-hmm. Jeff, as we think about what the majors, like the big producers, are doing with their cash, do you think there are differences between what normal investors, like let's say you or I, and what institutional investors want to be seeing them doing with that cash, the way that they're deploying it, whether that is, buying back shares or looking to expand their resources?
Again, another great question. But, when you look at all the analysts out there and you read them and you see some that make a very compelling opinion for why a company should buy back shares. And the next day you read a very compelling opinion from an analyst who says, no, we don't want to buy back shares. We want dividends and we want M&A. We want growth. So there are different opinions out there, very strong on both sides, and both have good arguments. So I think each company is going to have to decide, and you as an investor decide, okay, which would you rather see? But it's sometimes a company will be at a certain point where paying a dividend doesn't really make sense. It'd probably be better if they focused a little bit more on growth first, or share buybacks first. You want to be paying dividends when you're big enough to do so, and you're going to be able to continue to pay that dividend and hopefully raise it, right? Because lowering a dividend, decreasing a dividend, I mean, that'll kill your stock. And so you want a company that's going to be, certainly be able to pay that dividend on a regular basis and hopefully grow it.
Maybe another interesting way of kind of approaching the same type of question here, Jeff, is from more of let's say, a share structure standpoint. Would you rather invest in a company that is district size and has, millions and millions and millions of shares outstanding? Or would you be happier with a company that has a smaller resource and similarly small share count so that they can deliver, let's say, profit per share of a bigger company?
Well, if they're in production, that's when you look at profit per share. If they're not in production, then that's a different story. Mm-hmm. One thing I want to say is that a lot of companies will say they have district scale. And what they mean is they have a big land package and that's their district scale. Well, just because you have a big land package doesn't mean you have district scale potential. Mm-hmm. Now, you may, and there's some companies I've invested in that do have large land packages, but it's not an automatic thing. There are many that make that claim right on their homepage. And I immediately question that. I want to know, okay, do you have anything other than just lots of claims and lots of land? I'm looking at all the factors that go into a mining stock. Who are these people that are making this claim? Have they had, significant, meaningful success before? Have they created shareholder value? And many other questions. And I'm not trying to push the book, but they're all in there. I put everything, I think that would be helpful to people, and that's helped me over the years in the book. So I don't want something too small, but it's going to come down to economics and margin and that sort of thing. So if the margin is very strong for this company that's going to go into production, that can be attractive because they're going to be producing a lot of cash flow, right? Free cash flow. If it's not, then I'm less attracted to a small company and probably more attracted to the bigger one. Mm-hmm. So there are nuances, both can be attractive, both can be unattractive. So that doesn't really help answer your question, though, does it?
Well, I don't think it's ever always a black and white thing with this. You might have right. strong feelings one way or another, but you mentioned earlier that there are good arguments on both sides of many of these topics, and you couldn't tell that to somebody that feels that way more so than somebody like me that hears these arguments on both sides all the
right,
time.
I bet. I
mean, I can always see it, these different explanations all the time. So it's quite
I'm sorry. What I was going to say is it doesn't mean you're going to be wrong if you have strong feelings about going one way. It doesn't mean you're going to be wrong. Mm-hmm. All I would say is, hey, pull back a little from what that 100% certainty and deal with the question, what if I'm wrong?
Yeah.
Because, and that will help you really invest more appropriately, I think. Mm-hmm. Just ask that simple question. And I'm not saying you are wrong. I'm just simply saying ask that question so that you're prepared, in case it does go sideways or whatever. Mining is a risky business, even for producers, So I would encourage people just to be a little flexible.
Mm-hmm. So Jeff, you've mentioned that you're more focused on the junior side of things, whether that's a developer or a company like that isn't quite in production yet, or maybe a couple of years out. Why is that sector so much more exciting and interesting to you?
Oh, well, because of what the stock prices can do. Again, there's more risk there, but when you're on that side of production, you have a greater potential for a big gain. Now, of course, you're taking a bigger risk. There are companies that are just going to blow up and basically go to zero. if you're looking on the pre-discovery side. So what I like to balance there is some in pre-discovery that have not made a discovery yet, but have the potential to make the next Snowline Gold discovery. And then those that have made a discovery maybe even have a resource and are looking to grow it. I'm especially attracted to companies that can double or triple a resource, not grow it by 5 or 10%. And then the pre-producer. Now the developer, I mean, look, with the way things are with permitting and engineering and oh my gosh, feasibility studies, all that stuff takes a lot of time and a lot of dollars. And so I tend to wait until they're either at that construction or decision, or maybe before we pretty clear that a construction decision is coming, and then we'll be off to the races. That's when a stock gets re-rated. So the early developer, tend not to invest in. The later developer, I'm attracted to. But anyway, I try to balance between those three stages of companies, so you're not, all risk and you're not, taking too much risk by investing in just one, and yet you have the potential for big gains, especially if one makes a discovery.
Mm-hmm. So how do you think about that balance between metals as well, Jeff? Like, do you try to, take on and or balance some of that risk between other metals?
Yeah, that's a good question. So right now, I mean, you have to be in gold. I'm in gold. Silver plays because there's even greater potential there. And then definitely copper and uranium. Copper and uranium have similar supply demand, factors going on that are really going to drive those prices higher over time. Copper's was just at a new high the other day. Uranium is had a big run, has settled back for about a year now. So good entry point for uranium. But I think for both of those metals, there's a lot of potential still ahead. So what I like to do is, invest in something that, in a stock where the underlying metal has a bullish case to it. I am in a couple lithium plays, but the lithium market has been a tough one. The price that had big run up gave it all back, and now the market is oversupplied this year. I think that changes in 2026. Like Rick Roll says, the cure for low prices is low prices. I think that's what will eventually happen with lithium. But I like to be in companies where the underlying metal has a positive bullish case to it. And then looking at individual companies that I think we can get the biggest bang for our buck.
Mm-hmm. When we think about, what's ahead for copper here, Jeff, do you think it's possible that recent rise, and as you said, like a new all-time high in the copper price, is partially due to the tariff concerns, and that it could back off once the tariffs, I guess, are somewhat officially, possibly, again, announced on April 2nd?
Right. That's a good point. I think we could see a correction. We should be prepared for that. It's just like geopolitics. When something happens, gold tends to shoot up, right? And then once the geopolitical concern eases, it gives it all back, or at least some of it, right? I think we could see the same thing with the tariffs. The issue is it won't just be a tariff issue. There'll probably be a pullback if the tariffs really ease off. That doesn't seem to be in sight right now. But let's say it does, and at some point it will. What about inflation then? I don't think tariffs are going to be zero if you're going to take him at his word. There could be significant inflation again. That's going to affect interest rates. That's going to affect mainstream stocks. So there's a ripple effect there between all these things. And I think it's a great point you're making. There could be a correction once the tariff thing eases off, but I don't think that's going to be enough to kill the bull market in gold. There's just simply too many other factors.
Mm-hmm. But how do you see that for copper specifically? Again.
Oh, that's right. I'm sorry. Yeah.
We call it Dr. Copper. And if we do see things, let's say just taking tariffs, for example, if that continues to escalate, that would seem like we'll probably get on the margins less trade, affecting other countries around the world, possibly, really starting to push into recessionary territory for the rest of the world. Won't that affect the demand and therefore the price of copper as well?
Well, remember, it'll affect the supply as well because there's less free trade. There's going to be less supply coming onto a lot of these markets. I don't think the demand changes in the big picture, but it could in the short-term picture. And if we get a recession, the copper price itself is going to be affected. In fact, I went back and looked at all the recessions since the 1970s and measure what the copper price did during those. And the copper price has never risen during a recession. It's fallen in every recession since the 1970s. So you should expect some, a pullback if there's something that impacts economics or demand or something like that. But I think the bigger picture in terms of electrifying the world, even if they only get half of what they want, and half of these projections, there's still not going to be enough copper to meet demand, recession or no. So I think in the big picture, I would view a pullback in the copper price as probably a buying opportunity.
Gotcha. And how about for uranium as well? You mentioned that we've seen the price kind of come off over the last year here. Has the fundamental thesis really remained intact for uranium despite this pullback?
Yeah, the price is almost separate from the fundamentals right now because nothing's really changed for the fundamentals, the supply-demand picture or outlook, the political support, especially those that used to be against it are now for it. They're throwing money at it still. We have the U.S. supply issue where the companies are going to supply to the U.S. Uranium supply. I'm not making much sense, but so you have that political issue, and then you have the environmental issue. It's there's no greenhouse gases from it, so you have environmentalists that used to be against it that are now for it. So there's a lot of support behind it. So the growth trajectory is in place, and that trajectory is going to get some arrows at times thrown at it and some bumps along the way. But in the big picture, the uranium thesis hasn't really changed. It's still a bull market and still an investable asset that you want to be long if you're a speculator.
So at this time, Jeff, with this pullback, or maybe we should start with, what do you think explains this pullback over the last year?
In uranium?
Yes.
There was a lot of excitement. The price ran up. You remember there was a big spike in the price back in 2006, 2007, and it gave much of that back. This spike that we just had a year ago was the second biggest one. So it was a big spike. So it's normal for some of that price to come off. Some excitement came off. I think some realization that, okay, this is a long-term picture. You can't just throw in a nuclear power plant up tomorrow, that it takes time and dollars and permitting and all that to really make this work. So I think it was part of those things. But again, I just look at the fundamentals of that and what's already planned to come online. Even if a couple drop off, the demand is still going to far outweigh what supply we have. And with the tariffs and all the things that Trump is doing, that makes it worse, not better.
Jeff, do you think that with this pullback, are there any, differences in what you're looking at versus maybe 2 years ago? Like, are you looking at less established companies now, kind of more towards the junior side of things? Like, has this pullback changed what is attractive to you in a uranium play?
That's a great question. And the answer is, how some CEOs have to change their plans or modify their plans about what they're doing, focusing on getting into production. Oh, we better pull back and do something different. Or they have this, but they're going to push through with the little production that they have. They modify and adjust their plans based on what the market is doing, right? Well, we should do the same thing. It all still comes down to what risk level you want to take. But I like companies right now that while the price is down, they're quietly accumulating more land, or they're buying other assets, or they're doing some M&A.
They're trying to be strategic about using this time.
Exactly. So I'm attracted to that kind of company, again, as long as it's in a pro-mining jurisdiction and the people behind it have a track record of success. That's a simple must. If those two things aren't there, I'm just, it's just me. I'm not interested, and I may miss some, but that's just me. But the things that they're doing during this downturn, if they're productive, and even if they have to issue shares, if those shares, what they're using that money for, shows they could even have a bigger asset, or are more likely to make a discovery, or they just acquired somebody else, or whatever the case might be, I like that.
Jeff, I'd like to move a little bit to kind of the concept of how you build your portfolio, or how you think about your portfolio. Do you try to, let's say, rebalance your portfolio from, obviously you've vetted everything that's in your portfolio. So if you have something that has made an outsized gain over the last quarter, for example, do you try to trim that back and reinvest in other projects that haven't had the same success as one of the big ones maybe?
This is an important topic, and I address this directly in the book. And the reason I do is taking profits at a double or more is why my portfolio has gone from here to here over the last, 20 years or whatever the case is. I learned very quickly that if you take profits at a double, all of a sudden I still have exposure to that company, and I can go buy another company. Mm-hmm. If you take profits at a triple, you still have that company, and now you can go buy two other companies. I don't look at percentages too much. Schwab tracks it, so you can easily see it. Here's a good example. When Snowline Gold, we're at like 20x on the stock now. So that's insane. So I was just forced to take profits with each step along the way. And I still own a small position in it because I think they're probably going to get bought out at some point. But it was just getting to be too big of the portfolio, and it was risky for me. I didn't want to go from 20x to 10x. If there was a big correction or whatever. Of course, the opposite happened. It went from 10x to 20x, but still, I didn't want to have that kind of risk in my portfolio. And Tom, I can't tell you how many stocks I've been able to buy just from taking profits on Snowline Gold, and they're not the only one. Mm-hmm. So I really encourage people to consider taking profits. I asked everybody in the book. If you don't know, I interviewed 17 other people in the book, put them in, and this was a big topic. Like, do you take profits and when? And they all take profits, but they all take profits at different points. But the taking profits mantra doesn't mean you're dumping that stock. It means you're simply taking profits off the table, and you can keep your core position and still benefit if there's a big run in it. So that's kind of how I handle it.
Mm-hmm. Well, I think this also kind of ties into this idea that I've heard you speak about before, about the idea of dating miners versus marrying them. What is the nuance to understand there?
Well, you want to date because you may not ask them out on a second date or a 10th date or whatever. You don't want to marry them, right? Mining stocks are not going to be family heirlooms, except in maybe a very rare case. So they won't be in your will when you pass along. So And that's because mining stocks, A, are very cyclical. They're very volatile. It's the last place on earth you can be your own venture capitalist as a retail investor. But that comes with a lot of volatility, a lot of things that blow up, and a lot of good gains, and you're going to get a few big gainers. So you kind of want to find that balance. But it all comes back to the fact that since you can't hold them forever, and because of that volatility and because of the cyclical nature of them, you have to date them and not marry them. And when you look at the cycle, gold cycle is moving up now, but the mining stock cycle is kind of trailing. So you're still at the beginning of what we think will be yet another big upcycle for gold and gold stocks. So that's kind of how I look at it right now.
Mm-hmm. Excellent, Jeff. Well, I appreciate you shedding light and how you see all of these things. Is there anything that you think you'd like to leave the listeners to think about before we wrap up, maybe?
Well, I hate to self-promote. Everybody tells me all the time I need to do it a little bit more. But, as you know, we did acquire Gwen Preston's Resource Maven newsletter last summer. She wanted to do something different. She's now at West Red Lake Gold. So when we acquired her business, that took a while for the dust to settle, but we built a new website and did lots of crazy things. We've hired a full staff. So we're in position now. We're ready to rock and roll. For those that like silver, Peter Kraut came over from Gwen Preston's business, so he's with us now. We both have books. We have free newsletters. And by the way, I have the Gold Advisor free newsletter, which your audience is probably aware of. But Peter has just launched in January a Silver Advisor newsletter focused solely on silver. It's a sponsorship letter, just like Gold Advisor, but we cover companies for free in a newsletter. And he's doing really well with that, providing lots of education and everything in that newsletter. So we're ready to rock and roll. And I just will tell you that even in our paid newsletters, our goal is we want subscribers to make money, but they'll make money if I make money. And so I'm going to make money by making sure I put the best of best stocks in there, because our mantra is we have to own them. If we don't own them, they don't go in the newsletter. So everything in our newsletters, we personally own. Mm-hmm. And I'm going to do everything in my ability to make sure that this is as profitable as possible for me. And if it is, it's going to be profitable for subscribers. So that's where we're at with it. And I think there are some good times ahead, Tom.
Absolutely, Jeff. I couldn't agree more. Again, all of those newsletters and all of your content is all available at thegoldatvisor.com. And also excellent Twitter follow as well at The Gold Advisor. Jeff, thanks so much for your time today. Really appreciate it.
Great. This was great, Tom. Thanks very much for having me.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.